Salutations to you viewers. This is your host Bruno, the accounts doctor. Today we want to discuss the June 2024 Zimbabwe School Examination Council Principles of Accounting Paper 1. This video is going to be a part series video. We are going to discuss questions from number 1 up to 20 in the first part of the video. Then in the second part, we are going to discuss from number 20 to number 40. So the questions are projector. Discuss. So let's start. Number 1. Which of the following are assets only? When you talk about assets, we are talking about the items which are owned by the business, both intangible and tangible items. Intangible items, these are items that can be converted into cash, for example, inventory, cash at bank, and cash itself. Then tangible assets, these are non-current assets. Non-current assets, these are assets which can last longer in the business. For example, motor vehicles, machinery, plant and equipment. So let's look for my answers at now. A, pane cash, inventory and payables. Number A is wrong. Payables, these are liabilities of the business. So it does not, they do not qualify to be assets. But B, cash, payables and machinery is wrong. C, machinery, receivables and inventory. C is correct. Both machinery and receivables and inventory are all assets. So our answer is C. Let's move on to number 2. What comes after the ledger in the accounting cycle? So the accounting cycle says it starts with a transaction. Then after the transaction, we have the source document. After the source document, we have subsidiary book. After the subsidiary book, we have ledger. After the ledger, we have trial balance. Then after the trial balance, we have final account. Right? That is our accounting cycle. So when you talk about transaction, we are talking about the exchange of goods and services for money. That is what we say when you talk about transaction. So after the transaction, we got the source document. Source document, it involves my bank statements, my receipts, my debit note, my credit notes. Right? Then after the source document, we have subsidiary book. Subsidiary book, these are books of original entry. For example, sales journal, journal proper, purchase journal, sales returns journal, purchase returns journal. Right? Then we've got the ledger. Ledger, this is where all transactions are recorded. We have got general ledger, we've got sales ledger, we have got the purchase ledger. Right? Then after the ledger, we've got a trial balance. Right? The balances that are written in the ledger, be it sales ledger or purchase ledger or any other form of a ledger, are then transferred to the trial balance. A trial balance is a list of debit balances and credit balances that are extracted from the ledger. So after the trial balance here, we've got a final account. Final account, we are saying we are referring to the presentation of income statement and the statement of financial position, right? So according to our answers here, our question says, what comes after the ledger in the accounting cycle? So as you can see, after the ledger, we've got a trial balance. So our answer is D. That is our answer. Let's move on to number 3. Which of the following items is a set of input devices? Right? Input devices, normal devices, ekuti, we can enter information, then output device. Ndo akata se monitor, ekuteta kuona information that neta enter through the keyboard and mouse. Right. So according to our answers here, we have got a keyboard and mouse, per bit in a keyboard and speakers. A speaker is an output device, so it's wrong. C it in a mouse and visual display unit. Visual display unit is an output device, so C is wrong. D, speakers and monitor. Both speakers and monitor are output device, so our answer is A, keyboard and mouse. These are input devices. You can input information into the computer through the keyboard by typing. So our answer is A. Let's move on to number 4. Which document is used to correct an undercharge? Which document is used to correct an undercharge? A, we've got a bank statement. A bank statement, it is not used to correct an undercharge, because a bank statement is a statement that is issued by the bank to show the summary of transactions which occurred during the accounting period or during the operation of the business. So it is not used to correct an undercharge. Then B, we've got a credit note. A credit note is a document that is used to correct an overcharge. That is the use of a credit note. Right? C, we've got a debit note. A debit note is the statement or a source document that is used to correct an undercharge, which is the correct answer. Then D is a statement of account. It's wrong. It is not used to correct an undercharge. So our answer is C, a debit note, which is a statement that is used to correct an undercharge. Kati moti undercharge tirimboti chi? Tikuti isusu munhu atenga kana phone ye $50. No cost price. Anditika. Then anenge amutengesera phone iyoyo ozorealize kuti paitika undercharge. Pamwe phone iyoyo yanga ifana kuti chi $60. So panenge paitika undercharge ye $10. So that undercharge is corrected by issuing a debit note. So our answer is C, debit note. Let's move on to number 5. Which of the following transactions is recorded in the purchases journal? Purchase journal is a book of original entry that is used to correct credit purchases. When you say credit purchases, to tell that business credit. So those credit purchases are recorded in the purchases journal. So according to our answers here, we've got panampa A, pane purchase goods by check. Purchase goods by check is not recorded in the purchase journal. It is recorded in the purchases ledger. B, purchased good on credit from Tendai, which is the correct answer because we have said purchase journal is a book of original entry that is used to record goods which have been bought on credit by the business. So our answer is B. Purchased goods on credit from Tendai. That is our answer. Let's move on to number 6. Rent account is recorded in the A, general ledger, which is the correct answer. B, private ledger, it's a wrong answer. In private ledger, munowanika na capital account, need drawings account. Then C, trade receivables ledger. D, trade payables ledger. So, pama answers esati now, tinaona kuti general ledger is where we find render account. Render account inowanika mu general ledger. Ese ma account mazhinji anowanika mu general ledger kana kuti nominal ledger. The other name for general ledger is also called nominal ledger. So our answer is A, which is the general ledger. Let's move on to number 7. Which error is not reviewed by a trial balance? Right. Kana chiti ma errors asinga review any trial balance. Truth is susu. These are errors. Ekuti akaitika trial balance rinongo balance. And this. So truth is susu ma errors asinga review any trial balance. Truth is susu tine one tine the error of omission. Error of omission ndo ekuti transaction a transaction is not recorded at all in the books of accounts. In the books of accounts. This is the error of omission. Number 2, we've got error of principal. Error of principal, this is where the entry is recorded in the wrong account. For example, we can record capital expenditure as a revenue expenditure. So this is the error of principal. Then we've got the error of commission. This error occurs when a transaction is posted to the wrong account of the same class. Is posted to the wrong account of the same class. This is the error of commission. For example, electricity of 500 is posted to the general expenses. So about the electricity of 500 yaposa kwa account isiriyo, but it is of the same class, both SMA expenses. Electricity is an expense, also general expenses. These are form of expenses. So this is the error of commission. Right, so according to our answers here, the error which is not reviewed by trial balance, A, we've got compensating error. Right, compensating error is an error where the errors cancel each other. For example, sales of 250 have been overcast. Right? Then rent of 500 has been overcast. So this is the compensating error. In trying to correct these errors will cancel each other, right? So we are saying sales of 250 had been overcast by 250. Can I see overcast to tell my sales awanzwa? Antiga kuti isusu mune makatenga magudzi 250 muama record. Then mozoita error futi yekurecorda kuti makatenga futi magudzi 250. So in other words mune maitachi overcast. So in trying to correct the error, sales have got a credit balance. So to undercast the sales when they are overcast, we make a debit entry. To reduce the sales account, we make a debit entry because sales are overcast, which means itakama wedzera. So to To correct this error, we reduce these sales by making a debit entry. This is a journal entry. This is my debit side, this is my credit side. So, sales 250. Right? Then, rent of 500 has been overcast. Rent in a debit balance. All expenses, you've got a debit balance. So, to reduce an expense account, we make a credit entry. So, we are going to credit rent account by 500. So as you can see, these errors are cancelling each other, right? So according to our answers here, A, there's a compensating error that we are talking about here, that we have talked about. B, completing double entry with different figures. Completing double entries with different figures, it is an error which affects the trial balance. It will not balance at all. Error in extraction of balances, wrong. Single entry is wrong. So our correct answer is A. Compensating error is an error which is not reviewed by a trial balance. Ndo atuti ma errors ekuti akaitika trial balance rinongobalanza because they occur on the debit side and on the credit side. Let's move on to number 8. A club excluded subscriptions prepaid at the end of financial year from the income and expenditure account. This is in accordance with, right? A, we've got going concern concept. Right? B, we've got historical concept. C, we've got matching concept. D, we've got prudence concept. So here our answer is C, the matching concept. When we talk about matching concept, we are talking about matching the expenses with future revenue. Right? For example, a matching concept. Trikuti isusu. So matching concept mafambira anoita manje. Let's say business robot rent it pays an annual rent of 500. Right? On 31 December. Right. 20, let's say 2008. Then, muswa 31 December, rabadara more than that amount. Rabadara na 600. Right. 600 inenge ya prepayment. Kanauti. Inenge ya prepayment. Because business ranga chibadra in annual rent of 500. Barabadara 600. So, in other words, business inenge rabadara 600 minus 500. Ring rabadara $100 in advance. Saka $100 inenge isiri muna 2008. Teta kuyenza to the next accounting period muna 2009. Right? Ndo zvinotara ne matching concept. Right. So according to our answers at now, matching concept is the correct one, which is C. Which of the following is classified as a current asset in the statement of financial position? When we talk about current assets, we are talking about those items which can be easily converted into cash or intangible items. Those are not my current assets. Right? So according to our answers, we have got A, bank loan. Bank loan is not a current asset, but it's a current liability. B, bank overdraft. Bank overdraft is not a current asset, it's a current liability. C, trade payables is a current liability. D, trade receivables. That is our answer. Trade receivables is a current asset. My trade receivables, this refers to the amount of money that is owed by the customers to the business. That is my trade receivables. So business and my assets, my current assets. So our answer is D. What is debited in an asset disposal account? Right? What is debited in an asset disposal account? So our asset disposal account, when we talk about asset disposal account, depreciation, right? So depreciation is the loss of value of a non-current asset over its useful period of time, right? So when you dispose an asset, let's say asset rate to dispose, can try to tengesa rene cost here 500, and then it's need to tengesa ni mari ne 600. 500 e tinoenda no debit mu asset account ndo madono i debit imomo, right? Me asset ratengeswa. Sorry, we don't debit it, right? Chino debit kwa mu disposal account. Chino debit as the cost of an asset ratengeswa. Cost of an asset ratengeswa ndo ino debit kwa mu disposal account. Then ku credit side ku disposal account, chino isa the amount of money that we received when we sold, and when we disposed that non-current asset. So we debit side to dispose our account. Kuno iswa the cost ya asset ratengesa, right? So kwa answer say that na opana hapa, we've got cost price of an asset, which is correct. Then B, loss on disposal. It's wrong. So SM answers are wrong. My proceeds from disposal. Provision for depreciation. Provision for depreciation is credited in the asset disposal account. So our answer is A. Cost price of an asset. Let's move on to the next question. Which of the following is revenue expenditure? Right. Cooperative community business. I don't think my expenditures of various types. Right? Tinano is my revenue expenditure. I know my revenue expenditure. These are costs which are incurred to maintain the day-to-day running of the business. Right? These are also called the regular costs. I gotta say rent, my wages and salaries. Right? Jesus, I gotta say insurance. Then in capital expenditure, these are costs which maintain the value of a non-current asset, right? That would be my capital expenditure. For example, extension of a clubhouse building, number one. Number two, purchase of a machinery, right? It's an example of a capital expenditure. So for my example is 13 now. For my answer is 13 now. A, the cost of maintaining a non-current asset. Cost of maintaining a non-current asset is a capital expenditure, not a revenue expenditure. B, the cost of paying a non-current asset, right? B is the correct cost of paying a non-current asset, right? C, cost of transporting a non-current asset. Cost of transporting a non-current asset is a capital expenditure. D, legal cost of acquiring a non-current asset is also a capital expenditure. So our answer is B, cost of paying a non-current asset. Which of the following shows correct source of information for control account items? Right, so at my control account, we are talking about the sales ledger control account, which deals with trade receivables. Kana kuti my customers anenge atenga magoods business nechikwereti. Right. We have got purchase ledger control account, which deals with credit purchases. Right. So tine mamwe items anoiswa items anoiswa control account, ingave sales ledger control account, ingave purchase ledger control account. Pane kwaanenge achibva ndo yatiri kuti source. So question is which of the following shows correct source of information for control account items. Right. So A pane item ne source. Sapa item pa A tine bad dates. And my bad dates anooneka ku cash book. My bad dates awaoneke mu cash book because my bad dates vanhu vasingabhadhire chikwereti. Plus cash book aridhile nema non cash items. Cash book rinodhila nemari dziri kupinda mu business. So my bad dates haatopinde mu cash book. So A is wrong. Returns inwards. Pa item pane returns inwards, then pa source pane purchases returns journal. Right. My returns inwards hawaoneke ku purchase returns journal. Because purchase returns journal ndo atiri kuti ma returns outwards iyayo. So my returns inwards hawaoneke mu purchase returns journal. Right. C, we have got returns outwards. Right, returns outwards. Pa source anooneka sales returns journal. This is wrong also because returns outwards are the same as purchases returns. So my returns outwards anooneka mu sales returns journal. Anooneka mu purchase returns journal, sorry. That is where we got returns outwards. So C is wrong. Then D, set off anooneka mu general journal. Right, this is correct. Set off anooneka mu general journal. So the answer is D. When updating a cash book, which item is recorded on the debit side? Right, when you update a cash book, right, cash book kuti update a cash book, tinenge taona kuti balance iri ku bank statement. Iri pa bank statement ne balance inenge iri ku cash book zvine zvakasiyana. So we need to update the cash book. So paku update a cash book, we've got a balance. We've got balances which appears on the debit side and balance which appears on the credit side. So our question is, when updating a cash book, which item is recorded on the debit side? Right, we've got bank charges. Bank charges hawaoneke ku debit side because bank charges are expenses. Right. Sezvanambotaura zviya kuti ku debit side cash book kunopinda mari dziri kupinda mu cash book, then ku credit side kunopinda mari dziri kubuda. Right. So bank charges is the wrong answer. B, dividends received. That's correct. Right. Company can receive my dividends. The amount for the dividends received is debited in the cash book. C, interest on bank overdraft. Interest on bank overdraft is an expense. It is credited in the cash book account. D, stop order. Right. Can I stop order? This is an instruction given to a bank to cancel the transaction. Then on the stop order. For example, mkamba munange mabiwa mari through the bank. Right? So, munhu yeye anenge mari anonanga da kutransfer that amount to his what? To his account. So, there have to be a stop order. Inenge iri instruction inenge ichipiwa ku bank to cancel the transaction inenge yaitika, the illegal transaction inenge yaitika. So this is what we call the stop order. So our answer is B, dividends received. It is debited in the cash book account. It is recorded on the debit side. Right? Markup is obtained by. Markup is obtained by. So how do we calculate markup? Markup, we say gross profit over cost of goods sold times 100. When you talk about markup, we are talking about a gross profit, a gross profit that is expressed as a percentage, right? So markup, for us to get markup, we say gross profit over cost of goods sold. Gross profit markup is equal to gross profit GP over cost of goods sold times 100%. ndokuti tiwane chi inonzi markup. Then kune chi chinonzi margin. Margin is a gross profit expressed as a percentage of sales turnover, right? So margin will be equal to gross profit over turnover times 100. How do we calculate the turnover? Turnover imari yatinowana kana talesa anonzi returns inwards from sales atinenge taita. Tomboti tatengesa sales e500 kuma customers, then pamagoods atinenge takatengesa e500 pane paine 200 anenge ari defective kana anenge ari unsatisfactory. So 500 minus 200 we get 300. So this 300 ndo yatiri kuti turnover. So when we are calculating the margin, we say gross profit over turnover times 100%. So let's go back to our question. Markup is obtained by gross profit over cost of goods sold times 100. So our answer is A. Closing capital can be calculated as, right? When you calculate closing capital, we are talking about the statement of financial position. That is where we find the closing capital, in the statement of financial position. So to calculate closing capital, we say opening capital, but not financed by statement of financial position. So for us to find the closing capital, but not financed by more statement of financial position, true, but that is Suji, financed by opening capital, right? Then we add net profit. Then we got the answer, right? Then we less drawings. I took my drawings chi. These are goods or cash taken by the owner of the business for personal use, right? So we less drawings according to the business entity concept, which states that a business and its owner are two different things. That's why we less drawings here, right? So we less drawings. Talesa my drawings. Ndo patri kuona our closing what capital. This is how we got the closing capital. So according to our answers here, iri kuti opening capital minus net profit minus drawings. This is wrong. We don't subtract net profit. Then B iri kuti opening capital plus net profit minus drawings, which is correct. So our answer is B. Which of the following items is debited to a receipt and payment account? Right, so a receipt and payment account is an account that is prepared by non-profit making organizations. When you talk about non-profit making organizations, we are talking about clubs, right? Parastatals, right? nanazupo ndo anonzi non-profit making organizations. Ndo ma-organizations as ano-operator to help the community, right? Kwete not for profit making purposes, but to help the community. So resistant payment account inogadzirwa nema-non-profit making organizations. Then kuma profit making organization kune kuine bank account or cash book, right? So our question is saying which of the following items is debited to a resistant payment account, right? So on the debit side of a resistant payment account, tinenge tichirekodha mari dzinopinda mubusiness, ma-inflows anenge achipinda mubusiness. Then on the credit side tinenge tichirekodha ma-outflows akata se-purchases of equipment, right? All expenses, payment of all expenses, for example, rent, wages and salaries, right? So let's get a answer. A, payment to suppliers. Payments are not entered in the debit side of the resistant payment account. They are entered to the credit side. B, proceeds from sale of sports equipment. When we talk about proceeds, we are referring to mari yatinenge tawana kana tatengesa anything yatinenge tatengesa mubusiness. Mari yatinowana, right? Ndo atiri kuti ma-proceeds. Toona kutengesa kana equipment kana kuti machinery. Sa mari yatinenge tichireceiva isusu ndo atiri kuti ma-proceeds, right? So B is the correct. Then C iri kuti purchase of refreshments. Purchase of refreshments imari inenge ichibuda mubusiness. So it is entered ku credit side resistant payment account. Then D, purchase of sports equipment. Purchase, it's an outflow iri kuitika mubusiness. So imari inenge ichibuda. Saka our answer is B, proceeds from sale of sports equipment. Let's move on to the next question. Current ratio is, so in accounting we've got my accounting ratios. My accounting ratios, my ratios anoshandiswa to measure the performance of the business. Tinanonzi my liquidity ratio, tinanonzi my profitability ratios. My profitability ratios ndo my ratios akata sana markup nana margin, right? Then my liquidity ratios ndo my ratios akata sana current ratio, liquidity cannot acid test ratio ndo anoenderana ne-statement of financial position, right? So current ratio is, right, pa 18 total current assets over current liabilities. B, tine total current assets minus closing inventory over current liability. B is wrong because this formula is used to calculate the acid test ratio, so it's wrong. C, total current assets minus opening inventory over current liabilities, wrong again. Then D, total current assets over total liabilities. This is also wrong. So our answer is A, total current assets over current liabilities. When you are calculating a current ratio, we say current assets over current liabilities. So our answer is A. Which of the following ratios is calculated using cost of sales? Right? Which of the following ratios is calculated using cost of sales? So A, we have got current ratio, which is wrong. We don't calculate current ratio using cost of sales. B, we have got margin. It's wrong again. We cannot calculate margin using cost of sales. We calculate margin using turnover. Then C, markup, which is the correct. We can calculate markup using cost of sales. So our answer is C. Number 19. In a manufacturing business, which is a factory overhead, right? I took my factory overhead. These are indirect costs or costs which cannot be easily traced in the product manufactured. My cost I think I can identify a product rengira produce kwa, right? So do I took my factory overhead. Then tinema direct costs. My direct costs, these are costs which can be easily traced in the product being manufactured. For example, manufacturing wages, my patent fees, my direct materials, right? That took my direct cost. So question is, in a manufacturing business, which is a factory overhead, A, machine lubricants, B, manufacturing wages. Manufacturing wages is not a machine of a factory overhead. It's a direct cost. Then patent fees. Patent fees is also a direct cost. D, royalties. Royalties. These are also direct costs. So our answer is A, machine lubricants. Then number 20. Cost of raw materials consumed is, right? So in a manufacturing account, we need to calculate the cost of raw materials, right? So pekutanga tine opening of open inventory of raw materials in a manufacturing account yoyo, right? Tutanga open inventory of raw materials, right? Open inventory tutati ma raw materials atatanga nawo patatanga ku manufacturing zvedu. Then tatazoti add purchases of raw materials antika, right? Kana paine ma carriage on purchases tinoma add foot, right? Then to also lesser the closing inventory of raw materials. So according to our answers here, A, iri kuti opening inventory of raw materials minus purchase of raw materials minus carriage on purchase of raw materials minus closing inventory of raw materials is wrong. B, opening inventory of raw materials minus purchase of raw materials plus carriage on purchases minus closing inventory of raw materials, it's wrong. C, opening inventory of raw materials plus purchase of raw materials minus carriage on purchase of raw materials on purchases minus closing inventory of raw materials, it's wrong again. D, opening inventory of raw materials plus purchase of raw materials plus carriage on purchase minus closing inventory of raw materials. So D is our answer. So we have come to the end of this discussion. I hope we have learned something. So on the next episode, we are going to continue from number 21 up to 40. So this is your host, Bruno, in collaboration with the Found Media Educative TV. Signing out.